Hello everyone. Recent few days have been anything but normal. War, oil above $100, and the stock market back in panic mode. The Dow is down around 500 points, the S&P and Nasdaq are under pressure. But the real question is, what now? Let's get started.
So, is this just short-term panic or the beginning of a much bigger crash? In today's video, I'll explain in simple terms how the US-Iran war, the Strait of Hormuz, and $100 to $200 oil can directly impact your portfolio, your EMIs, and your daily life. Stay till the end, because in the last part I'll share 3 clear action points that I am personally following. Part 1. Let's first understand what is actually happening. Imagine it's a normal trading day. Indices are moving slightly up and down. Everyone is busy with their routine. Suddenly the news hits. The US-Iran war is intensifying, and in the Strait of Hormuz, through which roughly 20% of the world's oil passes, there are attacks, threats, and disruptions. What happens next? The first thing to react is oil. Prices jump above 100, intraday spikes go even higher, and traders' screens start turning red. When oil jumps like this, the market thinks only one thing. Transport becomes costly, production becomes costly, electricity becomes costly, which means lower profits and higher inflation. Because of this fear, the Dow slips by as much as 500 points. The S&P 500 and Nasdaq also move lower, and global markets shift into a risk-off mood. Part 2. Why is Hormuz so important? Now the question is, why is the Strait of Hormuz so important? In simple terms, it is the world's oil highway. The major oil tankers that leave the Middle East have to pass through this narrow gate to reach the rest of the world. If there is war, mines, drone attacks, or shipping disruptions here, the supply chain can literally choke. The market knows that if supply is at risk, prices will not come down quickly. That's where the fear of $100 to $200 oil comes from. Iranian officials have signaled that if the conflict escalates, oil could move toward $150 to $200 per barrel. And whether it actually reaches that level or not, just this expectation is enough to make markets nervous. Investors are thinking one thing. Higher oil means higher inflation, more pressure on central banks, and problems for growth stocks. Part 3. Oil, earnings, and inflation. The story of your portfolio. Now, let's connect this to your portfolio. Suppose you hold stocks in airlines, logistics, autos, or any energy-intensive sector. For these companies, fuel cost is a major expense. When oil moves from 70 to above 100, their cost lines shoot up. Either they raise ticket prices and product prices, which can slow demand, or their profit margins shrink. In both cases, earnings come under pressure. When analysts see that next quarter's profit may come in lower, they start cutting target prices and downgrading ratings, and the stock price falls further. On the other side, the inflation game begins. Expensive oil means expensive transport, which gradually lifts the price of almost everything. Central banks then start thinking, do we need to keep interest rates higher for longer? Do we need to delay rate cuts? If rates stay high, growth stocks, especially high PE tech stocks whose valuations depend heavily on future cash flows, get hit because their discount rate goes up and their theoretical value comes down. That's why you see war headlines on one side, and on the other side indices like the Nasdaq reacting indirectly through oil. Part 4. Are we heading towards stagflation 2.0? This situation brings back a very scary word, stagflation. Stagflation means slow growth combined with high inflation. If the war drags on, oil stays high for a long time, and corporate profits are squeezed, GDP growth can slow down. At the same time, fuel, transport, and food prices can keep inflation sticky. Markets hate this combination because central banks have limited options. If they fight inflation aggressively, growth slows even more. If they support growth, inflation can move out of control. Because of this uncertainty, you get large intraday moves. 300 and 500-point swings in the Dow, and spikes in volatility indices. Actionable steps. What can a retail investor do? Now the practical question, what should you do? Number 1, avoid panic selling. War-driven spikes feel emotional, but dumping your portfolio on every headline is not a long-term strategy. Number 2, check your sector exposure. Are you over-concentrated in high fuel-sensitive sectors like airlines, autos, or chemicals? If yes, consider gradually rebalancing, not during a crash, but on relief rallies. Number 3, think about hedging and diversification. Having some allocation to energy producers, commodity-linked plays, or defensive sectors can reduce your overall portfolio volatility. My goal is not to create panic, but to give you perspective. War headlines will come and go, but if you focus on structure, risk management, and asset allocation, you can survive these phases. If this story-style breakdown helped you understand what's happening, make sure to like this video, subscribe to the channel, and tell me in the comments how you are personally handling the oil spike in your portfolio. If you want a dedicated video on exactly which sectors could be winners and losers in a 100+ oil environment, write Oil 100 in the comments below. I'll see you in the next video. Until then, stay informed, stay disciplined, and invest safely.